Welcome back to Alpha Recap, your post-market rundown from stockalpha.ai. Glad you tuned in. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, we're coming to you after the close with a tape that was, well, choppy, but ultimately almost flat. Lots to unpack.
Exactly. The headline was Quiet Indexes and Noisy Internals. The S&P 500 finished the day essentially unchanged, down 0.02%. The Nasdaq 100 slipped just over 0.1%, and the Russell 2000 was down about 0.05%.
So, what really stands out here is that those tiny index moves hit some pretty dramatic swings at the stock and sector level.
Right. You had a headline-grabbing guidance miss in enterprise security that knocked a company down sharply, while other names, retail, utilities, materials, were getting bought for very different reasons.
And just to name the extremes, without getting bogged down, one cloud security company plunged roughly 31% after issuing what management called prudent guidance. Contrast that with a retailer that jumped about 12% after beating expectations. Big divergence.
That guidance-led crash really set the tone in parts of tech. It forced quant desks and analysts to reprice growth for related software names, and that pressure showed up in the tech-heavy indices, even though the overall market barely budged.
Yeah, that tracks. But it wasn't just tech. Energy desks were on edge after reports of disruptions around the Strait of Hormuz, which lifted crude volatility and helped some producers and service providers. It just didn't turn into a broad energy rally.
Right, selective strength rather than a sector-wide push. Utilities were one clear winner. Investors were buying into clean energy deals and infrastructure commitments, treating those names as defensive, income-oriented plays with longer-term cash flow.
Totally. And materials and mining actually outperformed on the back of project wins and deal activity. Those companies tend to move when there's tangible contract news. That's exactly what we saw.
Which meant the tape was more about rotation than a classic risk-on or risk-off day. Investors were shifting exposure across sectors based on headlines rather than taking a broad directional bet.
Quick reaction? Not great for small-cap leadership.
Big move.
Interesting.
Let's walk through the main sector storylines so listeners can map the dynamics to pockets of the market.
Go ahead.
Utilities drew flows because of clean energy deal announcements and infrastructure commitments. The narrative was simple. Investors want lower volatility, yield-like exposure, and those deals made a handful of names attractive.
Right. So the thesis was defensive growth plus income. If you step back, it's logical in a market that's waiting on clearer inflation signs.
Exactly. Materials and mining, winners on project wins and deal activity. Those moves were more fundamental and contract-driven, which is why they stood out against the headline noise elsewhere.
Energy was mixed intraday. Geopolitical noise in the Strait of Hormuz pushed some energy names higher, but broader risk dynamics kept a lid on it. So you saw pockets rally, not a whole sector surge.
Communication services and media had pressure in places, with investors still parsing monetization and margin stories for ad and subscription models. And real estate had deal-driven headlines, plus some policy concerns that weighed on a subset of REITs.
Financials were similarly mixed. Moves were idiosyncratic and tied to earnings or specific deal flow, rather than a coordinated reaction to rates. Small caps lagged, which tells me institutions weren't broadening exposure.
Which is important. When small caps don't participate, it suggests managers were cautious about a broader rally. They wanted higher conviction.
And on the crypto side, there was renewed institutional demand that helped names tied to digital infrastructure and custody services. That buoyed a few corners of the market, even as major cap indexes stayed muted.
So what does this mean for the Fed narrative and macro context? Markets were waiting on clearer inflation and labour data. Traders continue to price a Fed that's data-dependent. Cooling inflation alongside a tight labour market keeps the terminal rate debate alive.
In plain English, investors weren't willing to re-lever the whole market without signs that inflation was sustainably coming down. That showed up as muted index moves and selective buying.
And the reverse is true. If inflation surprises to the upside, or wages re-accelerate, flows would likely retreat to defensives and push short-term treasury yields higher. Benign readings would help growth and tech names re-rate.
So everyone's watching the macro calendar. PCE, CPI, payrolls, and Fed speeches. That's the quick takeaway on positioning.
Now let's run through a few notable individual stock moves so listeners can connect headlines to market reaction.
Sure.
First, that cloud security name we mentioned earlier plunged roughly 31% after prudent guidance. Analysts and quant desks rapidly reprice growth expectations across cloud security vendors, creating spillover selling.
Yeah, that was the loudest headline. It reminded everyone how fragile sentiment can be for high multiple growth software when guidance slows.
On the positive side, that retailer, Abercrombie & Fitch, jumped about 12% after an earnings beat and upbeat execution commentary. A classic example of how quality beats could still attract meaningful buying, even on a hesitant day.
There were also smaller, interesting moves. Aerospace suppliers benefiting from the space tech halo, and commodity-linked names drawing attention after fresh analyst notes or coverage changes.
Right, one coal company stayed in focus after analysts weighed in, and a data center initiative from an environmental tech firm highlighted ongoing investor interest in infrastructure and emissions reduction plays.
Across the board, the theme was divergence. Big negative shocks in high multiple growth software, matched by concentrated rallies in select consumer and industrial names that had concrete catalysts.
From a technical and market structure angle, volatility stayed low by historical standards, even as individual equities saw big moves. Breadth was narrow, leadership was concentrated. Liquidity was okay overall, but order books thinned on headline-driven swings, producing outsized moves in some names.
That's important for listeners who trade individual names. Thin order books can amplify price moves on headline days.
Totally. So looking ahead to what will matter in the next session, first, the macro calendar. Inflation and employment prints will immediately inform Fed expectations and the equity risk premium.
Second, Fed speak and minutes. Any tilt in messaging could shift positioning quickly, especially if officials emphasize data dependency.
Third, energy headlines. Any renewed developments around the Strait of Hormuz or shipping disruptions could reprice risk in commodity-linked equities.
Fourth, earnings and guidance. Today showed how guidance drives outsized moves. So upcoming quarterly reports will be under a microscope.
And finally, market breadth tests. Traders will watch whether rally attempts broaden beyond mega-cap leaders into small and mid-caps. A sustained pickup in Russell 2000 relative strength would be a signal that risk appetite is returning.
So what should listeners remember when they put together a watch list or think about positioning? A few quick takeaways.
First takeaway. Today was headline-sensitive rotation, not a clear market pivot. Respect headline risk.
Second, sector leadership was narrow. Utilities, materials, and select consumer names outperformed, while parts of tech and media were pressured.
Third, the market remained data-dependent on inflation and labor. Until there's a definitive macro signal, expect episodic rotation rather than broad conviction-driven rallies.
And fourth, individual company guidance and contract news can create outsized moves, so listen to management commentary carefully.
A couple more quick practical notes. This episode was recorded after the close, so everything we discussed happened during the trading day. And this is for informational purposes only. Analysts note that these observations aren't investment advice.
We won't tell you to buy or sell anything. The data suggests themes and momentum, but any decisions should be made with your own advisors.
And before we sign off, a little market colour. Honestly, I was a bit surprised by how muted the indexes were, given some of the headline swings. It felt like a day of waiting for clearer macro signals.
I know, lots of drama in single names, but the overall market acted like someone trying not to react. Classic selective rotation.
Okay, final quick recap. Indexes finished essentially flat, with the S&P 500 down 0.02%, the Nasdaq 100 down just over 0.1%, and the Russell 2000 down about 0.05%. Zscaler-style guidance shock in security software. Abercrombie & Fitch beat and rallied. Utilities and materials showed pockets of strength. Energy was mixed thanks to geopolitical noise, and breadth stayed narrow.
Takeaways. Respect headline risk. Watch macro prints and Fed speak, and keep an eye on whether small caps join any rally. Those signs will tell you whether rotation becomes a more durable shift.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close with another Alpha recap. Stay curious, everyone.